Chapter 18, Life Insurance and the Qualified Plan. True, false. Number 1, life insurance is advantageous in defined benefit plans because it adds to the limit on deductible contributions. And the answer to that is true. The book says when a qualified plan for a closely held business or professional corp is overfunded or close to the full funding limit for regular trusted plans, the addition of an incidental life insurance benefit or a change to fully insured funding may permit future deductible contributions at a higher rate than before. So again, we're trying to provide life insurance additional benefits to employees. Number 2, employer contributions to purchase life insurance within a qualified plan are not tax deductible. And number 2, employer contributions to purchase life insurance within a qualified plan are not tax deductible. Well, that is false. Life insurance within a qualified plan is tax deductible for the employer. Number 3, universal life insurance cannot be used to provide an insured death benefit under a qualified plan. And the answer to that is false. Universal life may be used to provide an insured death benefit under a qualified plan. However, they may be subject to the incidental limits applicable to universal life premiums rule. Therefore, there may be some limit, but it can be used. So the answer is false. Universal life insurance cannot be used. That is false. Universal life insurance may be used. The only issue is it may be subject to the incidental limits applicable to those life insurance, the same as apply to term insurance, but 3 is false. 4, one of the disadvantages of life insurance products is that policy expenses and commissions may be greater than that for comparable investments. That is true. That is always true of life insurance products. And number 5, for purposes of PTE 92-6, disqualified people could not purchase life insurance for you from a qualified plan, including your sibling spouse. And I will be honest with you, I have no idea what PTE 92-6 is. So I Googled it, and it's some exemption that labels employee benefit plan to sell life insurance contracts and annuities to a plan participant insured under such policies or a relative of such insured under the contract, an employer, any of the employees who are covered by the plan, etc. The book says the answer is true. I'll believe it. That's as far as we're going. You will not have a question on that. Number 1, the IRS has developed 2 tests for life insurance in a qualified plan designed to determine whether the incidental benefit percentage is being met. What's the maximum allowable percentage of total cost of the plan allowed for incidental benefits? The rules and the regs are 25%. Number 2, which of the following terms are used to describe funding in a combination plan? Well, first you have to know what a combination plan is. Defined benefit plans, it's particularly advantageous because it adds to the limit on the deductible contributions. Whereas compared to a defined contribution plan, the cost of the life insurance must be part of the contributions limit. Therefore, life insurance has more advantages in a defined benefit plan. If it's in a defined benefit plan, then there are 3 common approaches: the combination plan, the envelope funding plan approach, and the fully insured or the Section 412(e)(3) plan. So the answer is, which terms are used in the combination plan? They talk about whole life policy, the side fund, and the conversion fund. The envelope fund is one of the 3 plans which are used in defined benefit plans. So 1, 2, and 3 only. The answer is C. Which of the following is true of fully insured pension plans? A, they may be funded by a combination of life insurance and annuities, and that is what it is. Nothing about premiums increase annually. Nothing about plan benefits may exceed contract benefits, and nothing about policy loans. The book says a plan is considered fully insured for the plan year if it meets the following requirements. First point, it's funded exclusively by the purchase of individual insurance contracts. Under the regulations, such contracts can be either individual or group and can be life insurance or annuity contracts or a combination of both. So fully insured is a combination or both of life insurance and annuity contracts. Which of the following correctly describe taxation of an insured death benefit received by a beneficiary from a qualified plan? 1. The pure insurance element is normally tax-free. Well, that's true. 100% of the benefit is distributed tax-free. Well, that's not true. Non-death benefit distributions are taxed as qualified plan distributions. That would be true. And Table 2001 costs paid by the participant may not be recovered tax-free. That is false. So the answer is 1 and 3A. Number 5, advantages of using life insurance in a plan include all of the following except. So all of them are good except for one. Are there predictable plan costs? Oh, yes. Is it a very safe investment insured by insurance companies? Yes. Retirement benefits can be guaranteed because it's insurance? Yes. Low-cost installation and service of the plan? Yes, other than the cost because of the commissions might be slightly higher. And that relates to E, greater rates of returns on insurance cash value than alternative investments. That is not true. They're normally invested in more conservative investments. So the answer is E. 6, in a combination plan, retirement benefits are funded with a combination of A, whole life policies, right? Because you have the policy for life. B, term life policies. Well, those would expire at the end of the term, so I don't think those would be part of it. Assets in a side fund. Yes, a side fund are one of the particular points of a combination plan. So the answer is A and C. The answer is D. Alternatives to using life insurance in a qualified plan include group term life, yes. Split dollar life, yes. Personally owned life, yes. D, all of the above. A and the B would mean that personal owned life insurance could not be, and it can. So the answer is all the above, D. 8, a pension plan is considered fully insured for the plan year if it meets all of the following requirements except. And I quickly looked through it and I see B, the plan permits only highly compensated employees the right. Well, you can't do that. You can't discriminate. So the answer right off the bat is B. 9, the amount of death benefit provided for an employee in a combination plan is determined by using the defined benefit plan. It's the 100-to-1 test. Number 10, Well Corp has a life insurance policy on the life of the owner, Ben Well. Ben plans to retire in 5 years, 65. At that time, he will receive $2,000 per month. The face value of his insurance policy is $210,000. The IRS will treat Ben's life insurance plan as an incidental death benefit, right? Incidental benefits are not taxed. And what's the rule? Isn't it 100 times the monthly benefit in insurance? So 100 times 2,000 would be 200,000. This exceeds his amount that would be necessary for it not to be incidental. Therefore, the answer is false. And you can see the answer here. The face value of Ben's policy is more than 100 times his expected monthly benefit. Number 11, Harold Walters, age 39, runs a tax accounting. He employs 5. He wants to install a defined benefit plan for himself and his employees funded with life insurance, but he wants to retain some control over the plan investments. As his financial advisor, you tell Harold that the type of funding that would best meet his requirements is, because he employs only 5 people, and because he wants to have some control over the side fund, then using insurance and his side fund investments, and a relatively small number of individuals, his best choice would be a combination plan. Hal Staten died earlier this year at age 70. He was covered by life insurance provided by his employer's defined benefit plan. His son Walt is the beneficiary. The death benefit was $100,000. When Hal died, the policy had a cash value of $10,000. Walt then, A, receives the entire benefit tax-free. Well, that's not true because it had a cash value of $10,000. Must pay tax on the entire $100,000. That's not true because there is some pure insurance benefit. Must pay tax on any death benefits received above $50,000. That has nothing to do with it. Receives $90,000 tax-free. That is correct. That is the pure death benefit because $10,000 had cash value. And E was must pay tax on $90,000. That is incorrect. Correct answer is D, because the pure insurance element of the insured plan death benefit, which is 100 minus 90, is income tax free to the participant's beneficiary. And question 13 asks if the plan trustee can borrow against the cash value of life insurance policies held in the plan. And the answer is yes, they can, because it's life insurance. The only issue might be unrelated business income tax if the funds are used to invest in non-business related activities. So the answer is A, yes, the trustee may borrow against the cash value of the life insurance policies held in the plan.